let's be honest about something that most people in the personal finance space are too polite to say out loud. Being a millionaire on paper isn't the finish line anymore, and it definitely doesn't mean you're buying a private island or flying first class to Dubai every weekend. We grew up with this cultural archetype of the millionaire as the monopoly guy, someone with a top hat and a monocle who lights cigars with $100 bills. But the reality of hitting that seven-figure mark in modern America is significantly more boring and infinitely more complex. But here's the truth that gets buried under all the flashy Instagram lifestyle content. Reaching $1 million in liquid investable assets, not your house, not your car, but actual money working in the market, is the single most important tipping point in your financial life. It is the specific moment where the math of your life fundamentally breaks the relationship between how hard you work and how much money you have, effectively flipping the switch from a labor-based existence to a capital-based existence. So today, we are going to strip away the hype and the clickbait to look at the brutal, unvarnished mechanics of what actually happens when you cross that threshold, specifically for those of you between 30 and 40 who are starting to see this milestone on the horizon. First, we have to clarify a distinction that confuses about 90% of the population, including a lot of people who think they are financially literate. Net worth is a vanity metric. Investable assets are a utility metric. You can have a net worth of $1 million because you own a nice house in a booming suburb of Austin or Seattle that is appreciated like crazy. But unless you plan on selling that house and living in a tent, that equity is dead money. It's trapped behind drywall and property taxes, doing absolutely nothing to pay for your groceries or fund your retirement next week. When I talk about the $1 million rule, I am talking strictly about capital sitting in your 401k, your Roth IRA, and your taxable brokerage accounts. This is the money that constitutes your golden goose, the self-sustaining engine that exists solely to generate returns. If you run the numbers using the standard 4% rule, which, despite the debates, remains the best heuristic we have for safe withdrawal rates, a $1 million portfolio generates $40,000 a year in gross passive income. Now, $40,000 might not sound like quit your job and buy a Ferrari money, and that's because it isn't, but you have to look at it through the lens of survival mechanics. $40,000 covers the baseline survival costs for a single person or a lean couple in many parts of the United States. It's the mortgage or rent, the utilities, and the food bill, generated without you lifting a finger, answering an email, or sitting in a Zoom meeting. If you manage to push that yield to a more aggressive 7% return, perhaps through a dividend growth strategy or simply during a bull market run, that machine is spitting out $70,000 a year. Think about that for a second. That is the equivalent of the median household income in the United States, produced entirely by your capital while you sleep, play video games, or spend time with your kids. This is the tipping point because it is usually the first time in your life that your money is working harder than you are, and more importantly, it's the first time your investment returns might exceed your annual salary. However, getting to this level triggers a massive psychological shift that almost nobody warns you about, which brings us to the transition from growth to preservation. When you are in your 20s and you have $50,000 in your portfolio, a 10% market correction is, sure, annoying, but it's a $5,000 loss that you can probably make up with a few months of aggressive saving. But when you have $1 million on the line, the math of volatility hits you in the gut with a force that can physically make you ill if you're not prepared for it. A standard, boring 10% correction, the kind that happens basically every year or two, wipes out $100,000 of your net worth in the matter of days or weeks. See, losing $100,000 feels very different than losing $5,000. That's 2 years of median salary, or a luxury car, or a down payment on a house just vanishing into thin air because the Federal Reserve decided to hike interest rates. This is why the get-rich strategies that got you to the first million are often the exact opposite of the stay-rich strategies you need once you arrive. You stop trying to find the next Tesla or Bitcoin that's going to do a 10x return, and you start obsessing over asset allocation, diversification, and downside protection. You start realizing that a 50% loss requires a 100% gain just to get back to even. And at this scale, you simply don't have the time or the emotional bandwidth to recover from catastrophic mistakes. The game shifts from offense to defense. You start moving significant chunks of that wealth, maybe 60 or 70%, into broad market index funds, bonds, or even cash equivalents, not because they are exciting, but because they act as a seawall against the storm. You might allocate a small play money bucket, maybe 10 or 20%, for individual stocks or crypto or angel investing, but you do it with the explicit understanding that if it goes to zero, your lifestyle remains completely unchanged. This defensive posture allows you to sleep at night, which ironically becomes one of the most valuable assets you can own once you have something to lose. Now let's talk about the impact this has on your career, because this is where the concept of career sovereignty or coast fire really changes the texture of your daily life. Before you hit this milestone, your job is a survival necessity. You tolerate the toxic boss, the pointless commute, and the weekend emails because the alternative is missing a mortgage payment and ruining your credit score. But once your passive income can cover your basic keep-the-lights-on expenses, the power dynamic in the workplace completely inverts. Your employer is no longer your master. They are simply a client purchasing your time, and like any freelancer knows, you can fire a bad client if the terms of the deal no longer suit you. This is what we call FU money, although in practice it's usually more like no thank you money. It gives you the leverage to negotiate a 4-day work week, to turn down a promotion that comes with more stress but only marginally more pay, or to pivot into a lower-paying field that you actually enjoy. You might decide to stop contributing to your retirement accounts entirely, which is the core of Coast Fire, and just let that $1 million compound on its own for the next 20 years while you spend every dime of your paycheck on enjoying your life today. If you leave that $1 million alone at a conservative 7% growth rate, it will double to $2 million in 10 years and $4 million in 20 years without you adding another penny. Knowing that your retirement is already fully funded by your past self allows your present self to take risks that would seem insane to someone living paycheck to paycheck. You can launch a business, take a sabbatical, or accept a job at a nonprofit because you aren't working to survive anymore, you are working to self-actualize. However, with great power comes a great tax bill, and this is the boring, unsexy part of wealth that eventually becomes the most critical part of your strategy. When you were building your first $100,000, your biggest enemy is your own spending habits. But when you're managing $1 million plus, your biggest enemy is the Internal Revenue Service. A 1% difference in fees or taxes on a small portfolio is negligible. By on $1 million portfolio, a 1% drag is $10,000 a year, every single year, compounding against you. This is where you have to stop doing your taxes on free software and start thinking like a CFO. You need to understand asset location, putting high-growth assets in Roth accounts and income-generating assets in tax-deferred accounts. You need to understand tax loss harvesting, where you intentionally sell losing positions to offset your gains and lower your tax bill, effectively using the government's rules to subsidize your portfolio risk. Estate planning also stops being something old people do and starts being a necessary shield to protect your family. If something happens to you, you don't want a significant chunk of that $1 million vanishing into probate fees or being mismanaged because you didn't have a trust set up. But perhaps the most profound shift isn't mathematical or professional, it's psychological, specifically regarding how you perceive the passage of time. When you have zero assets, time is a cost. Every hour you spend not working is money you aren't making, which creates a subconscious guilt whenever you try to relax. But when you have $1 million working for you, you realize that your capital is earning money 24 hours a day, 7 days a week, regardless of what you are doing. This realization allows you to start buying back your time without the guilt. You stop looking at the price tag of a house cleaner or a direct flight and start calculating the value of the hours those conveniences save you. It's a shift from a scarcity mindset, where resources are limited and must be hoarded, to an abundance mindset, where time is the only truly limited resource you have left. You might find yourself becoming oddly frugal about things that don't matter, like brand name clothes or the latest iPhone, while spending lavishly on experiences, health, and family time, because you understand what actually drives happiness. In fact, you might find that your social circle starts to shift naturally. It becomes difficult to complain about monthly car payments or credit card debt when your biggest financial worry is whether the bond market yield curve is inverting. This can create a sense of isolation, a rich person problem that you can't really talk about with friends who are struggling, which drives many people to seek out communities of like-minded investors or mentors. You stop trying to impress the neighbors with a new truck because you know the guy driving it is probably financing it at 8% interest, while you were driving a 5-year-old Honda and owning the bank that issued his loan. That quiet confidence is the real dividend of the $1 million portfolio. It's the knowledge that if the world goes crazy, if the economy tanks, or if your industry collapses, you have a fortress of solitude that can withstand the siege for years, if not decades. It changes your posture when you walk into a room. It changes the way you raise your children, and it changes the way you sleep at night. The climb to the first million is a grind. It is full of sacrifice, delayed gratification, and boring repetition. But once you crest that hill, the physics of wealth take over, and the snowball starts rolling downhill with a momentum that is